Hi, hope you're having an amazing day ahead. Today, I want to talk about the opportunity cost of not investing in Bitcoin. Yeah. So this chart is actually first highlighted by Anthony Pompliano in his tweet. Yeah, and he basically took the 20-year annualized returns by asset classes from 1999 to 2018, right, from JP Morgan Research, and it shows that basically across many other asset class compared to what average investors earn, and right, what are the major asset class like gold earns 7.7% annually on average in the last 20 years, right? Oil 7%, and equity, right, which is represented by S&P 500, is only 5.6%. Yeah. So, and your average investor who invests in a mixed things, including cash of mainly USD in this case, right, get 1.9%. Why? Because of inflation of about 2.2%. So basically, it eats away all your returns. That's what basically this shows. Yeah. Now, he then brought up the question then, right? If this is the chart, if gold has been outperforming S&P 500, which is represented by equity and bonds, right, 4.5% over the last 20 years, right, then what could it mean for the native digital gold, which is Bitcoin? Yeah, and of course, we all know that in the last 10 years, right, because Bitcoin was only around last 10 years, the average return is clearly much higher than this 7%, right? It's easily like, right, it's from few cents to now it's about $5,000, or even at the end point of last year, the lowest point was $3,200. So even then, you're talking about thousands and thousands of percent, right? And yeah, so that's just what it means, right? And then he basically said, so look at it. What could it mean for you, right? If you don't invest in Bitcoin, this is what it means. You basically are losing out on a lot of returns. That's his point, yeah? But another Twitter user rebutted, saying that, yes, but is a function. The returns is very much a function of what time period you look at, and it is a fair assessment, and in fact, it's a fair criticism, because 1999 was when the stock market wasn't doing too well, right? And then he extended the analysis to 40 years and 80 years. So basically, then the chart is flipped. It means then the blue bars are basically representing S&P 500 or equity. Orange bar is representing gold. Yeah. So if you took a much longer period of 40 years and 80 years, which a more longer time horizon, then definitely equity has shown to be outperforming gold. Yeah, why we take gold is because gold is the most comparable one, the closest to Bitcoin, which means the cryptocurrency. We have the hardest form of money that we have today if you exclude Bitcoin, right? And cryptocurrencies, then gold is the hardest money we have today. So basically, this chart shows that, right? Although it's a very much a function of time period and what is the time period you actually start and finish. So that means market cycle plays a very key role, and that's exactly the point that Anthony Pompliano made in his newsletter to his subscribers, right? And I'm a subscriber, that's why I have access. And basically, then it says that equity on a much longer time period has shown to outperform gold. But gold basically is the more stable form of storage of your value, right? That's what it means. But again, this mixed picture of performance just means that market cycle is truly important. Yeah. So then now, what does it mean for you? And basically, he's making the point, right? And I agree totally that now that's the past. Let's look at future. What does it mean? What could it mean, right? Now, so the point here is that all other traditional asset class is at a high point of valuation, and that's why you hear a lot of people saying the market crash is going to come. And when that happens, every other asset class, the major traditional asset class, is going to crash eventually. And then, because Bitcoin and cryptocurrencies are a totally uncorrelated asset, because it's so new, it is super new. A lot of people are still not in this asset yet, right? So because of all this reason, and the reason driving it is completely different, right? It is more like a new technology, so you need adoption, and you need the entrepreneur behind a lot of projects, developing a lot of real use cases, and that is completely different versus the market cycle, the economic cycle that affects stocks and your bonds and your currencies, your FX, right, in the traditional asset sense, and your property. So because of that, he's making an argument, right? Why then everyone needs to have at least just a small percentage of your portfolio into crypto is mainly because of its uncorrelated nature, and because of other asset classes already at a high point of valuation. So for example, he's saying that we should look at future now, right? Because we are already at this point. So we should look at future. As an investor now, what do you want to put your money in? So he's saying that stocks, median PE ratio, the average price to earnings ratio for the S&P 500 for the last 150 years has been 15 ratio, right? So 15x. And in 1999, it was trading at 32. So super high. That's why it fell after that. So today we are at 21. So much higher than the 50% higher, in fact, than the long-term average, long-term median of 150 years, but still lower than the 99, peak. So basically then, a lot of people are saying, right, a lot of research houses, because stocks is very well covered, they are expecting an annualized returns of -3% to only +1% over the next decade. So very, very low percentage returns. Bonds, they are expecting that, right, average rate over the next 12 months, right, is only 2.5%, and it could only go up as high as 3.25%. And if you hold currencies, right, of course, we all need some currencies, but if you hold it in your deposit account, which will give you miserable return of less than 1%, but your inflation is really 2%, right? Or sometimes in most countries 3%. So basically you lose 2%, right? Because you get about 1%, inflation eats away 3%, so you actually is -2% to be exact, right? So you're actually losing money because you keep it in your deposit account, right? Or in the banks, or in your, right, or in your house. So it's basically what it means. Now, in the comparison, right, so Bitcoin, which is the longest established cryptocurrency with the longest history, right, have shown a historical returns, very volatile, but at the same time, you can see in this chart that it has gone up as high as 54 times, and in terms of percentage, it's 6,000%, right? Or even in 2017, it was 14 times up, yeah? And in terms of percentage, is 1,300%. But of course, it has also dropped very, very low, right? 73% down in 2018 because of this volatility, and it's mainly because of its new nature. It's such a nascent, right? And if you are able to weather this storm, right, just like a lot of the crypto funds and people who truly understand the value of Bitcoin and cryptocurrencies, then it doesn't matter, right, as long as you buy at a low price, which is relatively now, then if you weather on, and the chances of it increasing, there is that chance, then so you then will have a very, very hard, it will be a very valuable part of your portfolio. Now, we're not talking about asking you to put 100%, right? For people who are pro-crypto, they're still not saying putting 100% of your money into crypto. That's not what they're saying at all. But they're saying every investor who is rational, who want to achieve the highest possible returns for their portfolio, should have at least 1 to 2% of their allocation into crypto, and into only the top crypto, yeah? So why is that? Because simply of the potential. Of course, the worst case is that it can go to zero, but you lose 1 to 2%. But the potential upside can be huge, right? To potentially up to 35 times based on just today's prices and based on this one aspect of estimation. But of course, other people have estimated that it can even go higher. But let's just go with a reasonable way of estimates that I can at least somehow back it up. So if you look at the global real estate today, right, the market cap the value is about 217 trillion. That's what it means. And global debt, 215 trillion. broad money 90 trillion, stock market cap 70 trillion, gold 8 trillion, wealth of 50 richest people 2 trillion, Apple largest company, the wealth is 800 billion, silver 17 billion, and cryptocurrency market today after the recent rally is 175 billion. Yeah, so if you just allocate 1% of the traditional assets of real estate, debt, broad money is just your, all the money in your deposits in the bank today, stock market, right, gold, wealth of 50 richest people, Apple, and silver. If you just move all of those, 1% of all of those into crypto, that is $6 trillion, and that just boosts the market by 35 times from today. And that just means similarly for price of Bitcoin based on 5,000 today after the recent rally, it could go up to 175,000. Again, this is of course not financial advice, right? Very, very clear, not financial advice, but it has that potential to go up, right, to that level. But of course, it has also the potential to go to zero. But what are you losing here? You are losing 1 to 2%. But remember, if you invest in other assets, if you don't invest in crypto, your 1 to 2% invest in other traditional asset class like stocks, bonds, cash, FX, or property, you may not get a high return as well. And most likely for equity, you only get 1%, or maybe if you're lucky, 5% or even 10%, right? If you're super lucky, if you're able to really catch the point of low to buy in and high when you sell. Who can really predict that kind of buy in and sell out? No one really. And bonds, they're saying like 2 to 3%, and of course if you hold deposits, then you're actually losing money each year. Yeah, so crypto is then a good way to actually counterbalance all those negative effects, which you already know because those traditional asset class is very well covered by analysts, right? And generally they have a good way, because when so many people analyze it, right, the tendency of being efficient, that means people already price in a lot of knowledge, is super high. Whereas for Bitcoin and cryptocurrency, yes, it is a very nascent market, and because of that, it is likened to like Amazon and the internet in the early days, right? So but this is your chance now to just allocate a small percent of your money portfolio into this new asset class, and then you could potentially reap the rewards. But what is the worst case again? You could go to zero. But again, it's just 1 to 2% of your money. Will you sweat over it? Will you lose sleep over it? Right? If you will, then don't invest. It's really clear advice. But if you think you can stomach the loss of 1 to 2% of your portfolio over the next 10 years or 20 years, then but the condition is this: I think you must really hodl on, right? And follow the news, really, basically. What are people saying? What are the experts saying? Are they foreseeing already a peak of the market in the next 10 years? Then there's the time when you need to take profit and sell, right? Don't just hodl on blindly, but definitely when you hodl, you need to really follow the news, see what the experts are saying, right? See the people who have good track record, what are they saying? And a lot of them are actually calling for $3,000 was the bottom. But I mean, unfortunately for a lot of people, of course, they didn't buy at that level. A lot of time, in fact, you have 1 year at that time, last year, to buy at a low price of 3,000. Of course, a lot of people didn't, but now it has gone up to 5,000. Do you want to buy now? It's a question you need to ask yourself, right? I can't answer that for you, but I have laid out already a lot of the facts, right? But having said that, I also just want to balance it with a recent blog post by Martin Armstrong. Martin Armstrong is a very, very respected individual in the world of investing, yeah, and he is very, very super intelligent, right? Almost like a genius. I'm not sure if he's an alien, right? Because he's able to use his model, his proprietary model, to just predict, and he has a model that's able to integrate a lot of world events, a lot of across every asset class, right? That he then basically is able to integrate in such a great way, and he's able to predict a lot of the price movement, and he has been actually called the forecaster because he has been spot on, very, very accurate in a lot of his predictions in the past. So he has a very strong following. He doesn't need to actually have a lot of marketing and awareness, but he is clearly one of those people that people really, really listen to, yeah. And he advises a lot of institutions, and at one point he was even jailed because yeah, I mean, the government wanted his model, but he is not willing to give it up. So anyway, having said a bit of the context, right, and you can really read more about him from just internet, and he has also his own website, and I've put in the link to his website in this page. Now, he rarely talk about Bitcoin, and this is the first time it seems that he's publicly talking about Bitcoin and what is his views, right? And in short, basically, he really think of Bitcoin as just a trading vehicle. And in fact, just to demonstrate that, he has included Bitcoin as instrument, as a financial instrument in his model. So Global Market Watch and Socrates, which is his model, he's actually included it. And to him, right, it is just a tradable asset. It is a financial instrument, right? And he thinks the price is really a behavioral economics. That means it is a matter of demand and supply, and it is a matter of how people can come up with the right narrative that can affect the buying and selling decision of cryptocurrencies. That's what basically he's saying, yeah? And to the view where some people think that cryptocurrencies will replace money, will replace the US dollar today, his view is that it will never replace world currencies. That means it will never replace the government issued currencies, right? And his reasoning is because he thinks that governments, right, have such huge power, and he's basically asking the people, do you think that they will really give up their power without any fight, right? And surrender that power to something that is peopleless, right? That is centralist, like cryptocurrency. That's what basically he is saying. So, but then he believed that it is a tradable asset, right? But then he doesn't believe that it will have the tendency ever to replace the fiat money we have today, simply because of the power struggle he think. Now, what do I think? I agree that yes, will be very hard for the government to actually take it, hands down without any fight. But at the same time, we already have seen precedents in countries like Argentina, Greece, right, Zimbabwe, right, where really the government really wanted to have control, but because their fiat money have lost money so fast, right, that the people find a way to actually get hold of cryptocurrencies, because they really do see that cryptocurrencies are a better alternative to their money that they have, yeah, to US dollar, even if they can access to. So in those countries and in those circumstances, it's already proven it was no longer a question of whether cryptocurrencies is useful or not. It is being used already, right, just to get hold of normal things like food, like milk, something that we take granted in developed countries, but they already are using cryptocurrencies as a daily transaction means, right? May not be such widespread now, but regardless, it is a fact that they are using it now. And also, it is also a fact that a lot of major Wall Street names, even government sovereign wealth funds are not ignoring this technology, are not ignoring. In fact, Singapore government wealth funds, 2 of them are invested into the major cryptocurrencies, the largest cryptocurrencies that we have, cryptocurrency exchange that we have today, Binance and Coinbase respectively, yeah? So that ought to tell you something, right? I mean, what does it tell you? Just think for yourself, right? But of course, I agree totally, it is a highly risky investment, and that's why if you are interested, you should definitely do your own research. And even after you understand fully the merits of it, of investing in this as a tradable asset, as an asset class, as an alternative asset class, right? Invest no more than 1 to 2%, unless you are super high risky, clearly you can stomach the risk, right? Then potentially you can increase that even up to 5% or even 10% if you're super risky. But remember that it can always go to zero. No one guarantees it, and that's why people are highly discouraged from taking any debt to invest in cryptocurrencies, right? So with that, I would just want to end it here, right? And yes, there are pros and cons in everything. There's nothing that's perfect, But sometimes you have to take a leap of faith, but don't take the leap of faith blindly. It has to be backed by facts, by your own research, right? Do your own research and don't just believe what everyone's telling you, including me, right? Really, really get it out there, try it out for yourself, right? Maybe if you need that to believe, right? So yeah, okay, that's all I have for today. This is more really, I just want to give it for food of thoughts for you, yeah. And hope you're having an amazing day ahead, and I will speak to you tomorrow. Thank you so much for your support.